Hi everyone, and welcome to another episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan. On today's show, I want to talk to you a bit about when you're employed and self-employed at the same time. I think this is a particular interesting area. I think when you're starting out in business, maybe just getting yourself a side hustle as it's known, it can be quite complicated to try and understand, well, what have I got to do? You know, have I got to be registered? How's the tax work? Does it affect my main job? All of these types of things. So in this particular show, I wanted to talk to you about all those things. So let's get on with it. As business accountants, you'd imagine this pops up a lot, particularly in our conversations with startups, because it is one of these things that you just don't get taught. So I wanted to expand on it a bit on this podcast. I think I've done them over the years. I've done a few on this. So apologies if you've heard this before, but hopefully I'll bring a bit of a fresh take to it because the tax laws has changed. So going back to, I think it was 2020, I did a video on this. It's been relatively popular on our main YouTube channel, Heelan Associates, and just talking about it because a lot of people were starting up side hustles during those pandemic times. And from then on, it's kind of not a lot's changed in terms of we've had the tax allowances frozen. So a lot of the information I gave back then and in the previous podcast I would have done this is still relevant, but there has been some changes around things like national insurance. You might have heard some changes to something about the trading allowance, which aren't real, and I want to talk about that. So there's a few things like I just want to kind of update and refresh it, but if this is the first time you're hearing this information, even better. So let's kind of run through it. So the reason I love this particular topic is because it's the most natural way, I think, to start a business these days. It used to be the case, I think people, and it still is sometimes, people think in their head, well, I've got to go from employment, kill everything, make sure I've got a buffer, and then I'm going to go straight into my main job, into my main new job, if you like, working for yourself, being self-employed. The problem with that is, of course, it's high risk. It's high risk. And if you've never done it before, you don't even know if you're going to like it. What I love about this particular thing where you could build a side hustle on the side and maybe get to a tipping point and you think, now's the time, I can do the mathematics, and if I can earn enough now doing this in my sort of 5 to 9 in the evenings, what if I could do it all day? And you reach a tipping point where you can make that leap. Brilliant. But what you've proved is a few things during the time, and that's that the concept's good. People want to buy it. You've probably learned an absolute ton, and you've worked out whether you actually want to do it, because self-employment, entrepreneurship, whatever you want to call it, is absolutely not for everybody. In our job, we see so many people. I mean, sometimes it could be literally months. Someone will start with us, come on board, they're raring to go, they'll do one of our, say, like our accelerator programs or something like that, go through it all, got everything they need to do, and then you learn through our relationship with them, they're like on the phone crying. Sometimes that is the realism of it. They're like, I just can't do this. It's not for me. The cool thing about self-employment is it's relatively easy to shut down. You've probably not committed loads of capital, loads of sort of money at the beginning on it, unless you've got big bits of equipment. And it's just really kind of low admin burden. It's a good way to start up. So in our job, a lot of the time, we're trying to explain to people, actually, let's do this first. Let's perhaps not form a limited company day one. So this particular show is all about this idea that you're self-employed. So we're not talking about limited companies. We're only talking about self-employed people. And if you're thinking of testing the water on various things, this is often the most common route that we see, is to go into it like this. So that's why, and it is purely because it's easy to get going, and you can physically just get going. I think people worry about, okay, do I need to register with the revenue? Do I need to tell them, is it legal to suddenly start trading? Now, in some industries, you might need a license or something like that. So I'm not talking about where you need a business license, but from an operational tax perspective, you can literally stick up a Facebook page or a TikTok or whatever you want to do and start telling people you're selling stuff and get going. The actual tax paperwork and things like that can happen behind the scenes and lag behind later. Sometimes if you're going to do and there, of course, with anything with tax, there are caveats and exceptions. You know, if you're going to do 90,000 in the next 30 days, you need to think about your VAT and all this kind of stuff. But for most people, like the average person we're talking about in this podcast, it's not going to be the case. So you can just get going. And actually, that's the biggest thing, is we find that, and we've done plenty of podcasts talking about tips to get going. And this is always the kind of the main one, is actually get going. You can put all the things in place, but just start talking to people and see if anyone wants to buy your stuff and start figuring out how you're going to provide value. Anyway, could go on for that for a long time, but we're here to talk about the tax points. So it's really important. If you've got a limited company, you know there's a central place to register, Companies House. That's a public record. Everyone sees it. With self-employment, there isn't. So when you come to register a side hustle, all you're really doing is telling the revenue that you need a tax return. That's it. They don't even really do anything with the data. It asks you for a business name, but you don't even need to worry about it in reality. They identify you as a unique tax reference, a UTR, a 10-digit number, and that's all you are to them. So there's no kind of public register for this. And again, that's setting aside things like trademarks and things you might want to do, but the amount of people that actually worry about that is tiny, tiny. If I take the last 18 odd years of working with small business owners, thousands and thousands of clients clients over that time, I can tell you there's probably about 4 or 5 that have a bother with a trademark. Like, it's relatively small in the general kind of small business world, but sometimes that's a really useful place. So when it comes to registering, there is no central register. That's the main thing to get going. And when it comes to registering, there's some interesting places. So you don't have to register instantly. And this has changed a lot. If you've listened to maybe some of my content from years ago, I'd have said to you, you have to register as soon as you become self-employed. That used to be the advice. The problem is the tax law didn't support it. So now what they say is you have effectively 6 months after the tax year. So when the tax year finishes, so your tax year in the UK runs from the 6th of April to the 5th of April. When that's all gone round, what happens is you draw the line and then you've got to the 5th of October to after that tax year to tell them. So for example, if you started in September 25, the tax year is going to run round to the 5th of April 26, and you've got to the 5th of October 26 to tell them about it and get a tax reference. Now, sometimes what I would say to people is if you know that you're going to go self-employed and you start earning more than £1,000, or you know easily, like your first job's £2,000, you're going to, you might as well get registered early, because having that tax reference, getting set up with the tax office is really good just to get out of the way. And for some benefits, it's really important to have a unique tax reference to be able to prove that you were self-employed. So even though you don't technically need a tax return at that point, getting it early is a really good idea. Now, that tax return in that example where you started in the middle of 2025 in September in this example wouldn't actually be due until the 31st of January 27. So it's quite a long time away. That's also when any tax will be due. And we'll talk about tax in a minute. So you will go online, you'll get a personal tax account, you'll be able to apply for self-employment. It's not a difficult form at all, just takes you through the steps online, and you'll get this unique tax reference. That's kind of you for the tax office. Now, I mentioned £1,000. The reason £1,000 is important is there's something called the trading allowance. Now, the trading allowance, I always joked it was legalising Avon. So, I mean, Avon's probably not as popular as it was then, and there are other brands available. I mean, when back in my door knocking days, I used to do Clean Easy. That was one of the ones that was there, and it's this, MLM as it's known, multi-level marketing type idea where, you buy product and you sell it, in this case with Avon or Clean Easy or wherever else it was, door to door, and you do it and you get your customers and you'd make a margin off it, and somebody higher up the chain would make a margin off you, and it would work out well. And but there was a lot of people doing it, and they do tiny amounts of income in reality and barely make any profit. So I always feel like the government, back when they put this in place, were kind of just saying, yeah, we know this occurs, but by law you should tell us about it, but it's too much hassle and admin for everybody, so let's just not bother. Because at their end, there's cost for processing and checking tax returns as well. So they had this trading allowance. Anyway, that's just my thoughts on it, whether that's true or not. But it makes sense if you think about it. In the broad schemes, you don't want that many people who they really don't care about doing a tax return. So they made a trading allowance. And I won't go too deep into that. If you just stick in that into the podcast, you'll find other podcasts we've done. We've got blogs on the website and videos on the YouTube channel talking about this, but it basically exempts the first £1,000 from being taxable. And so what they said is, look, if you're not doing over £1,000 in your self-employment, then we don't need you to do a tax return. But there can be reasons to register. So there are certain benefits that need you to prove you're self-employed. So you need that UTR number. So I always think, look, if you're going to be serious about it, you might as well get a tax return. The only downside is the hassle of doing the tax return each year, but there is currently a free tool that allows you to do it. Now, there's something called Making Tax Digital, which if you go back a few podcasts I've talked about to be aware of. But if you're starting a business right now, you've got a few years to basically ignore that. The main thing will be keeping digital records, which I'll talk about in a moment. But it's not something that would immediately, if you're just testing the waters right now, there's absolutely a free tool at the time of recording this podcast where you can go on the revenue and do your tax return. So that the downside of registering is purely hassle. The upside is, though, you can prove that you were self-employed because you would have the references and everything else you need, and it's quite important for a few different benefits. So bear that in mind. So once you've got that and you've registered with the tax office, you've got it all going. But this trading allowance has some weird interactions as well that can actually benefit you when you go over £1,000, and particularly if your expenses aren't more than £1,000 because of the way it works. So check out the trading allowance for more details on that. But that's where that £1,000 you might hear about if you've done any research comes from. The reason I also mention it, and I think it's important, is that there's been some reports recently that the trading allowance is increasing to £3,000. Earlier in 2025, it was announced that it kind of sounded like that's what they were doing, but they just badly worded the press release from HMRC, is that the trading allowance isn't changing. What's changing is the reporting requirement. So I'm saying to you, at the minute they say, If it's under £1,000, don't worry. But that they are saying we're going to make that £3,000. But weirdly, it's still going to be taxable. So the bit between £1,001 and £3,000 is still going to be taxable. But they're going to have a new digital service for you to tell them that's not a tax return. It's really weird. At the time of recording, it's meant to be coming live soon. They said it would be August 2025 that the new digital system would be tested. So more details on that as it comes out. But that's generally what's going to happen. So you're going to be able to have that. So that's when you need to register. That's a little bit on the trading allowance. So you've got it there. Then let's talk about the tax on it. So a lot of people, they're like, okay, I understand I have to tell them about my tax, but how does it work? Does it affect my job? That kind of stuff. So how the tax return does it is, imagine the tax return is like this big bucket. All of your income that you're going to earn goes in. So we said about this idea that even if you started midway through the year, you're going to have to do a tax return for the year. So on there's various different pages where you put all your information in. And it has, let's say you've got, in this case, stereotypically, you're going to have a main job. So your main paid job, you're already paying tax and national insurance. And what will happen is it will want all of the data for the whole tax year. Now, in reality, what should happen is they should already know this. If you're using the free HMRC tool, in theory, it should pre-populate and tell you, we know this. If not, you'll get what's known as a P60, a form from your employer, somewhere in May usually, and it will tell you what you earn in a year, and I would still recommend checking that figure against the tax return pre-populated figure, because you'd be surprised the amount of times that's wrong, particularly sometimes from big employers. So bear that in mind, but do check them. So they want that whole year, and then they want anything else, any taxable interest you had. So not like ISA interest, but if you had some decent interest, that goes in. And there's a page for your self-employment. And you're going to put in the income that you had in your self-employment. If you want the trading allowance, there's a box to claim it, all this kind of stuff goes in. And what it does is it stacks your main job income, forgetting any tax you paid for a moment, your main job income, and then it stacks on top your self-employment income. And then it calculates what's the total tax bill of that entire income and chucks it out the bottom. Then it says, but you've paid tax in the job, so we're going to take that off the bottom. So most of the time you're paying the right tax in your job. So what it should really throw out is that you're just paying tax on this extra income. But it doesn't always pan out like that, because sometimes the tax in your job can be wrong, and it will also correct that. So it's one of the positives of having a tax return is at least you always know where you are with your tax, because it's amazing the amount of times we see clients who are coming out of employment, and because they've had a change of taxable benefits, say they had a car one year and medical insurance the next, and they're actually cranking up a tax bill behind the scenes, building a tax bill behind the scenes, and they just don't know. So one of the benefits is that it flushes it out, because at least you can see it. So that's how it works. Stacks all on, total tax bill, and then what they'll do is out there they'll say, right, okay, but you have paid this in the job, and it will throw it out. And that tax is due when your tax return is due. So in the example we were given, 31st of January 2027 is when you're going to have to pay for it. So now you might think, okay, how does that then affect my main job? And I'm going to talk about that in a minute. Does it affect it? Side note on this, if you're listening to this and you're in the construction industry, it's one of the rare places where as a self-employed person, you get tax deducted at source normally. If you're in the scheme, and you would know for sure, because it gets talked about all the time. And there's a box in the tax return to put the amount of tax you've been deducted. And it's very similar to how it is in the job. It just takes it off the tax that's owed. Now, frequently, because of the rates of pay in the construction industry and the reduction in national insurance that's happened and things like this recently, you'll get a repayment of tax sometimes. So it's very normal. If you're in the construction industry, you might be listening to this going, yeah, you might have heard the term like my rebate. People say, where's my rebate, mate? Can I get my rebate? That's what they're talking about, is that most of the time the tax you're being deducted is more than what your actual tax bill is by the time it comes to calculate it. So that's kind of where that comes from, but perhaps that's for another podcast. So then on the tax, let's talk a bit about how much tax you'll pay. And this is a really important concept to picture, because I said to you it's stacked. So if you think about it like a stack of books, your job income's up stacked first, and then you've, sort of stacked in, for ease, let's just say it's stacked first. Technically, it's kind of the same. But you stack your income first from your job, and then you'll stack in maybe a couple of extra bits on for your job profit, your self-employed side hustle profits. Now, if that stack reaches about 50K, it's just over 50K, but let's just keep it easy, over 50K, that's what's called the basic rate. Everything below the 50K line. Anything above the 50K line is then charged at 40% income tax, and then it goes up to 45. It gets quite expensive, but you've got a massive point before you reach the upper rates, but that's about 125 grand plus. But this basic rate to higher rate is becoming more and more prevalent. And the reason is that they've frozen that basic rate allowance a lot. If you've been keeping an eye on the news when they're talking about frozen tax thresholds, that's often what they're talking about. And of course, as earnings go up, more people end up getting caught into that high rate of tax, and that's what happens. But one thing that's really important that I think people misunderstand is it's not like if you go over, so say you do 52,000, it's not like all of your 52,000 is now being charged at 40%. It's only the $2,000-ish that's over the top that's paying 40% tax. So that's something to bear in mind, because I think people often think, well, there's no point me earning this side hustle money because suddenly everything, I'm going to be worse off and paying 40% tax on everything. You're not paying on everything. And as we'll talk about in a minute, actually, you're probably paying less of a tax rate on the self-employment than you are on your employed job. So that's something to bear in mind. So in terms of the tax rates, we said 20, 40, 45. There's also national insurance to consider. And this is one of the things that's changed since I last talked about this probably many years ago, is that the insurance rates, the national insurance rates of self-employed, what's known as class 4, they're a lot less. They're actually really attractive at the moment. They're only 6% is the main sort of rate of corporation tax. Talk about that too much, of national insurance. And that's on the bit under 50K. So the way it works is you've probably heard me talk about, or you've heard, if this is the first time you listen to me, you've probably heard of your UK personal allowance. So in your main job, it's very likely if you had no other income, they're using about 12.5 grand a year of tax-free stuff against your main job. So when we said we stacked all of your income up on a table, the sort of the bottom stack of it, that's about 12.5 grand, is already paying no tax. Now, separate to that, national insurance isn't like that. It doesn't combine everything. It actually looks at the individual income sources and says, are we at the limit where we need to pay national insurance? And if we are, you're going to pay it. So in your main job, if you've got any sort of income, you would have undoubtedly paid it. But it's almost like a second 12.5 grand limit. What they did is they aligned the national insurance threshold with the normal personal tax threshold. So that, because it used to get confusing, you used to have somebody that said, I'm paying no tax, but they'd pay national insurance, but that's all changed now. So if you're not paying any tax because you're under about 12.5K, you're unlikely to pay national insurance, but it's per income source. So you might well be paying national insurance in your own job. And then if this self-employed side hustle income went over about 12.5 grand, you'll also be paying this 6%. But it might not be 6% depending on where it is, because if your self-employed income starts taking you over 50K, then oddly the national insurance is only 2%, because basically you've paid the biggest chunk of your national insurance in your main job. So let's say, for example, actually you had a job where you're already paying 40% on some of it, you're 60 grand income, and then you're stacking up some side hustle income that's say 14 grand, you're only going to pay a couple of grand at 2%. That's just the way that it works. And that's quite hard to talk about in a podcast, but hopefully that makes sense. The national insurance isn't as big a deal as it used to be, but it's worth noting. It's worth noting because then that's where people go, well, hold on, 6% national insurance and I'm paying 20% tax if I'm in the basic rate. 26% seems like a lot of money, but it's unlikely that would be the case on most of your income, depending on in that situation. And what you got to remember is your actual job income. If that's you, if you're paying under 50%, under 50K a year, you're already paying 20% tax on most of it, forgetting the 12.5 grand that's tax-free. And then you're paying about 8% in your job on the national insurance, plus you're probably contributing to your pension. I know it's not tax, but net money that you get, you think about that. You're paying national insurance at 8 and 20% tax. That's more than what you're going to be paying your self-employed income. And the chances are on your side hustle, for most people, you're already not going to be paying national insurance until it actually gets to be substantial. So then you're only paying your tax. So again, the reason I sort of labour on this point is I want to encourage you to go and do the self-employment. I remember talking to my own kids about this, fun enough. They're of working age nearly. One is definitely of working age and the other one's getting there. And they're like, oh yeah, but tax, it's horrendous, isn't it? And I'm like, well, not really. Let's just look at it. What are you going to be earning sitting at home watching Netflix? Not a lot. Would you rather go and earn, 70% plus of it and have it in your hand? Yes, you would. So yes, tax is one of those things that is unavoidable. Successful people are going to pay it. We want it to be only what we should be paying. And that's the bit where, the kind of thing that drives me to do these podcasts is I want you to have the knowledge to know that you're only paying the right amount of tax and no more. And I don't want you to pay more just because you didn't know. And that's the thing that used to bug me when I first started being self-employed. So I wanted to know why somebody in the similar situation to me seemed to be paying less tax. And most of the time it was knowledge about what they could deduct and what they couldn't. So anyway, slight divergence, but do know that, I want to encourage you to get this other income and do it. And there are weird places in the UK tax system where you seem to be paying a certain rate, and then you can almost be paying 60 odd %. You might see these graphs if you start Googling it, because there are ones where you can start to lose personal allowances, tax-free childcare, this kind of stuff. So there are these weird things in the tax system, but I'm talking generically on most of the scenarios we see where somebody's in the basic rate of tax looking to do a bit of a side hustle income. It really isn't that bad compared to what you're already having. So bear that in mind. And if you hear things like emergency tax, it really isn't normally emergency. Emergency tax is a funny one. I don't know why they really call it that, because in the majority of circumstances, emergency tax is the tax you should be paying for other technical reasons I won't go into. So don't worry too much if you hear that terminology. Now, I did say, how will it affect your main job? And the reality is it probably won't. Your allowance is normally being used fully in your main job. So you're being taxed. The tax you should pay on your tax return should be just the self-employed tax. Doesn't always work like that, but sometimes. But it won't normally affect it. Sometimes there are rare instances where, you get a tax bill and they start to change your tax code. It is very rare these days. It used to be more prevalent years ago, but I think HMRC have got a bit, applied the law stricter. Maybe they got taken to task, because there was a time where they would adjust your code for something they felt should be in there, but it wasn't really legal of them, I suppose. So you could just phone up and ask them to remove it. So in current years, more sort of, what's the word I'm looking for? Not current years, but in more recent times, I should say, it's got to a point where they don't normally adjust your code. But if you've got underpaid tax from a previous year, something like that, they might start to code in, what they call code in. And what that means is they reduce that tax code a little bit to take more tax off you as the year goes on, because they know when it comes to the end of the year and you do your tax return, you're going to owe some tax. The idea is they're collecting it as you go, and at the end you shouldn't have a bigger tax bill, but it doesn't happen that much more anymore. So that could be the only thing, that your tax code, in theory, because of the fact you're submitting a tax return, could be altered. However, it doesn't mean, there are circumstances, you might already have this in your job at the minute, where they change your tax code and you're not submitting a tax return. So it could still happen, but that's the only real thing that's going to happen. As a reminder, your employer doesn't know. Your employer won't know that you're self-employed. They won't know that you've got this other side hustle income, unless obviously you're advertising on Facebook and they see it or something like that. So just bear that in mind. So yeah, generally it won't really affect it. The only thing, the outlying chance, is that your tax code gets adjusted. Now, in terms of how to plan this when we're talking about it, your tax bill, there's a podcast I've done a few times where I talk about the 25% rule. It's something that was taught to me many years ago when I first went self-employed and I had no clue. And they said, look, just put 25% of your profits aside and you should have enough. And if you're in that basic rate of tax, that under 50k total income, that's still a really good rule. I say rule, guideline. So go and listen to that podcast and I'll talk more about it. But that's the biggest thing in there, is just making sure that you're putting enough aside. Of course, if you're in the 40% bracket, 25% is not going to be enough. You might want to go and put literally 40% aside. Depending on how much it is, that might be completely enough, because I know we talked about national insurance, but it's for a lot of people doing side hustles, they don't go over about 12.5 grand anymore. So you don't tend to see too much national insurance for the average person. But if you're earning substantial money off it, you might need to increase that a bit more to know. But I'd argue when you start to get to the 40% mark, that's where you should be talking about, is a limited company a good idea for me? Because there's a lot more strategies you can use to really bring the overall effective tax rate down. So that's why in this one, most of the time, most people we see doing this, they're in the basic rate of tax, just looking to generate an extra bit of money. And that's where this most frequently happens. So have a look at that. Now, of course, on reducing tax, we already talked about the fact that your knowledge is going to be power for you. But I think there's a couple of key overall strategies when it comes to reducing tax. Keeping good records. So I would get yourself on some digital software as soon as you can, as soon as the business looks like it's actually going to do something. So I completely understand the argument that why would you want to be spending 30 to 50 quid a month on accounting software if your business really isn't actually doing anything? By all means, keep it on a spreadsheet. Making tax digital in the future may change this for you. And again, go back a few episodes if you want to hear about what the changes are for self-employed people there. But keeping good records is going to help reduce your tax bill just by the fact that you're capturing everything that you need to. So just make sure whatever your system is, it's really good at capturing everything, whether that's photos, whether it's in an app, whether it's you've got separate bank accounts. So separate bank accounts are good both for saving for tax and for capturing your records. Make sure you do that. Continue this knowledge that you're already doing. Listen to podcasts, watch videos. Just make sure you're on a reputable source. I can't tell you what a reputable source is. You might be listening to this. For all you know, I've made this up. I mean, I haven't. I've been doing it for 18 odd years, but I could be making it up. And so much of tax is about professional opinion. So what I say might be different to what another accountant says, and neither of us could be wrong. It might be our interpretation. If you've listened to enough of my content, you'll know there's a lot comes down to interpretation of the tax law and tax cases and where you see the lines. So and how you frame something. So there is all that. So just listen to multiple parties and do it. And if you are working with an accountant, just make sure that you're comfy, that they keep up to date and that they know what they're talking about. That's really, really important if you're going to take somebody's word for it. So that's important. And then, of course, as we said, plan for the tax bill, do it in advance. So put some money aside for your tax, do your tax bill nice and early. We said you've got that window where, if we use the example of 6th of April 2026, end of the tax year, you've got to 31st of January 27 to pay that tax bill and submit that tax return. So do it early. Don't be running around at Christmas trying to do it, or waiting even worse to the new year to try to do it. And then it might seem like a bit of a shock and, you don't know what's going on. Maybe you suddenly need to seek help and there's no time. I can tell you accountants are very, very busy in January, so you might want to bear that in mind. So they're the kind of key things, I think, to consider when you do it. But the great thing is, hopefully what you've taken from this is, while there are some complexities in it, all you've really got to do is go out there and get going, and know that at some point you're going to need to register for a tax return, most probably if you're over that £1,000, and there isn't really like a register or anything else. You need to go out and suddenly register and get going. It is all about you as an individual, making sure that your tax is sorted outside of the chance where you might need a license or something like that. But generally businesses in the UK don't need that. It's going to be, something, well, I don't know, you decide you're going to go sell alcohol, or you're going to be a taxi driver and you need a license or something like that. So that's where we're at. So hopefully that explains it and gives you some insight into how it goes. If you have enjoyed today's show, please do share it with anybody that you think needs to know this information. If you have enjoyed it, if you could subscribe via your favourite app, that'd be great, so you don't miss an episode. And if you do get 5 minutes, I'd love it if you could just leave a review on the channel. I know most of you find us through Spotify, but Spotify, Apple, wherever you are, if you could leave a few words and a review, that'd be amazing. Thank you very much. For more business insight and tax tips, be sure to connect with me and all of my team across the social media channels. We're on, pretty much every channel that you can think of. So we're doing a lot at the minute on TikTok, for a change. So there's some stuff on there. And of course, Instagram, LinkedIn, YouTube, and all the rest of it. Our main YouTube channel at Heelan Associates is where we do long form guides of this kind of stuff. We've also currently playing around with, we're just chucking these up. I'm recording them to camera as we're doing these, just as another way of getting people to be able to enjoy it. I have had a couple of comments where people have been like, this is good, because I don't really like to do it from my phone. I do like to watch it. So, and I think sometimes it's quite nice. I can ramble a bit more on a podcast. So that's cool. So that's up there, and that's it. If you just put HeelanHub into YouTube, you're going to come up with the other channel. So that's there. And it's a great way. If you have got any questions or comments, you can just put them in the comments there. I'll check them at least once a week and do my best to help you out. You can also sign up to our 2-weekly HeelanHub Herald, which is a email straight to your inbox, giving you some thoughts and some tax tips and business tips straight to your email. And you can do that by going to our website, HeelanAssociates.co.uk, scroll around for 2 seconds and the pop-up's going to pop up and you can sign up there if you want to. And we do not share your data with anybody. It's purely for us. That's it. And I did say about digital record keeping. So if you're in that world, HeelanAssociates.co.uk/0, the 0 with an X, and that's going to take you through for a great discount on a new Xero license to get you going into the world of Xero, which I don't know if you'd be able to see it on the YouTube channel, but we're big fans of Xero. There are others. I mean, we do a lot of QuickBooks, for example, so there are others, but we just find on feedback from, the reason we align ourselves primarily with Xero is feedback from clients means that they find it the easiest to use. And for us, it plugs into the most things in the market. Just they've got seamless kind of, I don't want to get too technical, APIs that allow us to do really cool stuff with clients with the data. So if you're going to pick one that's going to make your business scalable, that's going to be really important to go and have a look there. And if you do want to get in touch about the podcast, outside of commenting on YouTube, you can also email us direct at info@HeelanAssociates.co.uk. That's it. Have a profitable and tax efficient week, and I'll see you in the next one.